There is a time bomb ticking in corporate America, one that could wipe billions of dollars off of bottom lines. Company pension plans. According to Goldman Sachs, S&P 500 pension plans are only 79% funded, the worst level in at least 9 years, and record low interest rates are exacerbating the crisis. Mike Moran is a member of Goldman's public policy research team, and he is the man who crunched what you'd have to call some pretty ugly numbers on pensions. Mike is here with us this morning. Mike, we are talking specifically about defined benefit pension plans, not the 401ks that are very popular with sort of newer companies. How serious a problem is pension underfunding?
Well, Erik, as you point out, these are the traditional defined benefit pension plans where a company promises a pension to a retiree for the rest of their life. And right now, many pension plans are severely underfunded, primarily because of what's going on in the interest rates situation. With historically low interest rates, with rates having come down during the year, many plans are seeing pension obligations rise in value. That is putting downward pressure on their funded status, and that has direct implications for the companies that sponsor these plans.
Okay, very, very briefly, explain to us the mechanics of that. Why are the obligations rising in value relative to where we sit today?
Erik, when we think about what a pension is, it's really the present value of future benefit payments, so it's very interest rate sensitive. The way the financial reporting works for these plans is that companies have to value those liabilities based on interest rates that are currently available in the market. When we see how low interest rates have been and the fact that they've fallen year to date, many companies are going to have to use a lower discount rate for their pension financial reporting at the end of this year. That again raises the value of the obligations.
Mike, I'm presuming that Goldman sees some value in the work that you're doing, otherwise you wouldn't be producing these very lengthy reports. Do investors fully appreciate the sort of ticking time bomb quality to pensions, especially in this ultra-low interest rate environment?
Absolutely, Erik. I would say over the past small number of weeks and months, we've received a number of questions from our clients regarding how pension plans affect the companies that sponsor them. And again, it's really the low interest rates that have piqued the interest of both equity investing clients as well as creditors as they try to figure out how does that underfunded amount, how does that affect the balance sheet, the income statement, the cash flow of the company that I'm looking to evaluate.
Okay, so if you believe Ben Bernanke and other members of the Fed, not to mention all kinds of economic commentators out there, that we're going to be living in a low interest rate environment for a long time, what should companies be doing about the discount rates, the sort of, which is a proxy, I suppose, for the expected return in their pension plan over a long period of time? I'm looking at some of the numbers that you put together in your report. Sprint Nextel has a discount rate of 6.75%. Who's getting 6.75% today? And it doesn't look like they're going to get it for a while.
Well, that's the exact situation, Erik. We're looking at a situation where companies have to mark that discount rate to market once a year on the last day of the year. So in essence, really, it doesn't make a difference what the funded status looks like today in late October. For a calendar year company, it makes sense what it looks like on December 31st. With interest rates having fallen year to date, companies are going to have to reset that number on December 31st. If interest rates stay at the level where they are now, many companies are probably going to have to lower that rate anywhere from 50 to 100 basis points. That could add anywhere from 5 to 10% to their pension obligation.
And that could be a very big number if you look at some of the billions of dollars of obligations that these companies have. What do you think is a prudent rate?
Well, right now, when we're looking at where corporate bond rates are, a lot of them are around the 5 to 5.5% rate. But you can't make a blanket assumption across companies because every company has a different plan. The rate that a company selects is going to be highly dependent on the specifics of that plan, in particular the duration of their liabilities.
Mike, one thing I read in your research that really struck me is the degree to which many of these pension plans are shifting into fixed income. It almost seems like a counterintuitive way to tackle the outgrowth of the financial crisis. They're going into fixed income at a time when prices are at record highs. Spreads are very tight. Treasury yields are really low. Some people say we're in the middle of a bond bubble that's going to burst. If that happens, what happens to the pension obligations?
Exactly. Well,
or at least the plans and the underfunding status.
Understood. Understand, Erik, that many of these plans are going into fixed income, not necessarily because they find it an attractive asset class right now, but because fixed income securities are a better match for their pension liabilities. Pension liabilities are bond-like in nature, and again, they're discounted based on high-quality corporate bond rates. So by buying fixed income on the asset side, it's a better match for my liabilities.
So it might be okay provided they hold them to maturity.
Well, exactly. And also, given a lot of the accounting and regulatory changes over the last few years, companies have more of an incentive to minimize that volatility of the funding status. So by having assets and liabilities that are more similar in characteristics, it helps to minimize that and protect against interest rate risk.
Mike, great to have you here and give us a window into what's going on these corporate balance sheets. It's kind of alarming, frankly, when you look at the numbers. Thank you very much. Mike Moran of Goldman Sachs.